But on to our big spotlight then for this evening, and it has to be the IMF report, because ahead of its spring meeting, the International Monetary Fund has cut its forecast for global growth. The IMF now predicts global GDP will edge up only slightly this year to 3.2% from growth of 3.1% in 2015. That compared with the 2016 forecast that was earlier made of 3.4% that was made in January, and of 3.6% in the last report that was issued in October. The 2017 forecast was cut to 3.5% from 3.6% in January. The author of the report, Maurice Opsfield, spoke with CNBC earlier today. Here's a slice of that chat.
We've seen some loss of momentum in advanced economies, including the US, but also Japan. We've seen continuing headwinds in the emerging markets and the low-income countries, particularly for commodity exporters. We had another bout of financial volatility in the beginning of the year, and markets have largely recovered, but that takes a toll as well.
It might be somewhat surprising for people who follow commodities prices. Oil prices have stabilized a bit here. Do you not see any bottoming in the deep recessions of Brazil or Russia, for instance, as a result of what we've been seeing in commodities?
Well, we do see further out in our forecasts some restoration of growth in those countries, but we have to recognize they've also been stressed because of political pressures, geopolitical pressures, sanctions in the case of Russia. So ultimately, if you go out to 2017, 2018, we do have improvement.
You've really led the charge, you and Christine Lagarde, your boss, on easy monetary policy, more coordinated monetary policy, keeping low and easy rates, and cautioning that it's time to be gradual for the Federal Reserve. So does that mean an interest rate hike from the Fed as soon as June would be too soon?
The Fed is, I think, in a useful way, clearly taking great account of what's going on in the world economy and how that blows back to the United States. We can't really presuppose what conditions will look like in June. The Fed is following a data-dependent approach. They don't seem committed to any particular path of hikes, and I think that's appropriate.
So you won't say June, but you did downgrade the U.S. economic outlook for this year. Why did you do that if we are seeing some signs of stabilization in manufacturing and housing and even consumption, all huge parts of the economy?
Well, we certainly saw some loss of momentum at the end of last year, and that feeds through to our U.S. projections for the coming year. Even though the dollar has come down some in this year, it continues to take a toll on manufacturing and on trade. We're still seeing the effects of lower investment from the fall in oil prices. So those headwinds will continue for a little bit.
Maurice, congratulations on the new job. Can I ask you?
Thank you very much. Not so new anymore.
I'd really like your view on Japan. And the reason I'm asking you is because Olivier Blanchard, who had your job until recently, has just given an interview to the Daily Telegraph in which he suggested that Japan is heading for a full-blown sovereignty crisis now, with its debt at 250% of GDP close. And at the same time that negative rates are really just masking what is going on there, and ultimately they may not be able to attract enough people to buy the debt. What is the view on Tokyo?
Well, Japan really has to do more in terms of structural policy. It has a narrow path to tread given its high level of debt. So all of the three arrows have to be put into play. And, I certainly agree with Olivier that a lot of the burden has been put on monetary policy. That's been true in Japan. It's been true in other countries. So the other components certainly have to raise their game to get Japan back to more stable growth, to let it deal with its debt problem. And ultimately, the way it will handle the debt problem is by restoring faster growth.
On that note, let's quickly slip into a short commercial break on the big picture. But on the other side, we will dig into some of the key findings of that IMF report with Chris Palmer, founder at Benson Avenue. Stay tuned. Welcome back. And on that IMF announcement, I'm now joined by Chris Palmer, founder at Benson Avenue. Thanks so very much, Chris, for joining us here on The Big Picture. The IMF's global growth downgrade was pretty much expected, but what are your key takeaways from today's announcement, Chris?
Well, I think that some of the key points the IMF has raised is that trade is having a much lower impact on global growth, the net benefits of trade, either Chinese exports, turning into a negative driver for global growth, and also the big impact that lower commodity prices, which is a bit contrarian, but lower commodity prices has meant less capital investment in quite capital-intensive industry, and I think that's part of why we are seeing these very steady but slow cuts to the global growth outlook, is less capital investment and really declining benefits from global trade, really marked by the net benefits of trade that are coming out of places like China.
Well, that's interesting. You mentioned the global trade growth, but in terms of the anti-globalization voices that are gaining strength, especially in much of the developed markets, do you see any immediate turnaround as far as global trade is concerned?
Well, I think one of the big surprises of the last year has been the growing academic evidence that although in theory free trade is supposed to create a level playing field of winners and losers, there is certainly some evidence or some arguments in some corners that some countries have benefited asymmetrically from free trade. And, there is real interest out there in examining some trade arrangements and if need be, go back and re-examine things like tariffs, for example. Certainly here in the UK, the impact of free trade as it's had on the steel industry is just a current headline, but is a very real issue considering the importance of the steel industry to many of the economies of Europe and particularly the UK.
Well, that's interesting because what you're essentially saying now that with more academic research, the intellectual oxygen that the free trade arguments have traditionally received is now drying up.
Yeah, and I think, part of that is because regulation and environmental standards and labor laws, they differ so much in all of these countries that one would have expected the steel industry in various countries, for example, to have fought back a little bit harder against some of the big players like China in the steel industry. But the fact is that entire industry may be very poorly positioned for a competitive position in countries in Europe, the UK or the US, for example. It remains to be seen. I mean, free trade has only been really around for 30 or 40 years, and in the case of China, for less than 20 years. So it's a short time period, but certainly what we've seen is not only relative losers created in certain industries, but absolute losers, where we've seen, we've seen people exit the industry.
Well, those are important words coming in there from you, Chris. But since you're with us, a word also on the U.S. economy, because IMF reckons the economy will grow at about 2.4%. But clearly, when we look at the manufacturing numbers, it still shows that its manufacturing remains fragile. And there are, of course, also risks of a stronger dollar that could hurt American competitiveness in the export markets.
Well, I mean, the pressure has been taken off the U.S. dollar since the last Fed meeting. We've seen the dollar come off its peaks, and that's probably created some relief in global markets. Remember, the U.S., one of the big drivers for the U.S. Economy in the last decade has been all of that money pouring into investing in the energy industry. And as the IMF's already pointed out, lower commodity prices have led to a big slowdown in capital investment in that area. So around manufacturing and job creation for industry, the energy industry had been a big job creator. It had been a big area of growth. And with the lower oil prices, you've certainly seen the foot come off the accelerator in that area for sure. With more stable commodity prices, though, with oil drifting back up towards the high end of our forecast range, you could see some stabilization in those growth numbers, less projects canceled, and a bit of a rebound in the U.S. oil sector.
Well, the IMF report talks about the need for structural policies, fiscal policies, and monetary policies. But in an era where we've seen central banks using all kinds of unconventional monetary policies, as our governor likes to put it, do you feel monetary policies are now fast reaching their limits in terms of how much of an impact they can have on reviving growth?
Yeah, I think that way too much attention now is being paid to top-down decision-making and top-down leverage that monetary policy might have over real outcomes in terms of business decision-making, capital budgeting, and investment. I think at a certain point, monetary policy was important because it stabilized the financial system, which is, of course, critical. But if you look at, the banks in the United States, and because they were the first mover in the U.S. to stabilize the banking system, it's been about 8 years now since monetary policy was loosened sufficiently to stabilize the banks. What we're, failing to see is that monetary policy has led to real, significant increases in capital investment or corporate budgeting. And that's where the paralysis really is in the USA, but also in Europe and the UK, is that corporations remain very nervous, and that, of course, spreads to their workforce, who possibly are underspending relative to their old behaviors of, let's say, before the financial crisis.
Right. And especially at a time when central banks are even going in for negative interest rates, one wonders how much lower can they go. So pretty interesting times ahead. But thank you so very much for taking your time out and joining us here on The Big Picture.